Thank you very much for coming. As you can all see, it's quite an international panel that will focus on success stories from Central Eastern Europe. So I wanted to first ask you, Florian, you're looking into covered bond research and you cover that market globally. And I was wondering what, in your view, the 2018 was as a year for the covered bond market, and what the 2019 may be, and how the covered bond directive actually plays a positive or less positive role in terms of the global market and development of covered bonds.
Okay, thank you, Jacek. I was asked yesterday already to sort of say a few words, 5, 6, 7, 8 minutes. I think at some point you said I have as much time as I want to, which is a bit of a dangerous statement when you
Absolutely,
talk about covered bond analysts in general. As you mentioned, I'm based in Frankfurt. I've been looking at this market for, gosh, I don't know how long, about 15 odd years. Not quite as long as Richard, but I'm quite a dinosaur in this market as well, big nerd. I'm not going to talk football either because I'm German and I don't think I need to go much more into detail in that sense. I'll just try to give a broad sort of international sort of perspective on this space. Because 2018 is sort of the last year, and that's the main reason or main issue really. Directive is not so big of an issue these days, especially for investors. It's not an issue at all because the timeline is extending out a few years into the future. It's something I discuss a lot with issuers, but on the investor side, it hardly ever comes up, to be honest. And I mean, Rich and I will spend a bit of time later discussing this. What has been the main determining factor for how spreads have moved, how issuers have moved, how volumes have moved, has essentially been QE, or the not end of it, because we're not at the end of it, but so the last year of actual net additions to the purchase program. That's been the main driver for the past 4 years, essentially, because we've had those guys buying a lot, amassing about a share sort of in the overall Euro benchmark market of around 40-odd%. So almost every second bond, if you want to sort of say or sort of stick to that mental image, is held by the guys in the big tower in Frankfurt and the various subsidiaries around the Euro system or the Eurozone. And they've squeezed out a lot of investors. They've squeezed spreads to very, very tight levels and essentially empowered issuers to just do whatever they wanted, really. They were clearly in a position of power, and they just pushed investors around however they pleased. Now, as I said, we're approaching the end. But if you look at covered bonds, the actual end, so to speak, or the kickstart starting point for a bit of a normalization, that started as early as March, because the Eurosystem quite actively told the issuers, guys, it's been brilliant. Over the past 4 years, you were able to rely on orders from our side that were around 50% of the expected issue size. So as an issuer, you knew half of my bond is pre-placed. Investors knew half of that bond is pre-placed, so execution risk is low. So they were not happy to accept, but in the end accepted spread levels that they otherwise wouldn't have. And in March, the Eurosystem said, okay, guys, this has been it. It's been a brilliant ride for you, not so much for the investors. We'll sort of start to normalize this now. Our orders are not going to be 50% anymore, but they'll be at most 40%, and the emphasis being on the at most and not on the 40% number. And that led to quite a bit of nervousness on the issuer side. It was real sort of 180 degrees as far as psyche and psychology is concerned. You had a lot of issuance throughout the first months of the year. Usually you have seasonal patterns where come March and then April sort of issuance slows down after a really active start to the year. This time there was no slowing down. They just kept issuing and issuing and issuing. And the result was spreads that just kept widening. And just to get a rough idea on so the distance that we've covered by now, in the sort of German space, because it's been mentioned a few times as the benchmark, so to speak, and the biggest or the longest or the oldest market, they had bonds trading in the mid-swap minus 25, 26. They were issuing close to mid-swap minus 20 at some point. Nowadays, you have them issuing in swap positive territory, so we've moved a good 20, 25 odd basis points, which for German or any core European covered bond is quite something. So I'm not saying we're in a normalized market environment again, and we're not quite there yet, but we've already covered quite a lot of ground. And on the investor side, you can sense that as well. I was banging my head on doors that just wouldn't open for quite some time because investors behind the door were just like, yeah, just no, not interested. it's too expensive. We can't trade this stuff. There's no rationale for us to have covered bonds as part of our asset allocation. Bank treasuries prefer to rather just put the money at the ECB deposit facility and amass a huge amount of excess liquidity there. Asset managers just moved into higher risk assets. Insurance guys, yields were too low, so they just kind of tried to chase real assets, lending, actual sort of infrastructure projects, etc. And that's starting to change as well. I'm getting meetings with people I had absolutely no chance of getting one, and I would tend to think that it's not because of me personally, but just the market as it was for that period of time. So it's normalizing on that side as well. Directive, as I mentioned, is for an investor too vague a concept. Everyone assumes, okay, it's improving our situation incrementally from where we are now, so it's not a negative. It's a sort of minor positive, but again, one that will not play out in 2019. So for people with a 12-month horizon as far as measuring performance is concerned, it's not yet a driver. The driver really has been QE, reducing orders, and that's already taken place to a large extent. Looking into 19, again, those factors aren't going to be much different in the end. You will still have sizable reinvestments from the Eurosystem as far as the APP, CBPP3, ABSPP, CSPP, and PSPP is concerned. Secondary versus secondary, so secondary buying this year versus secondary buying next year, it's probably not going to change. That's probably going to be exactly the same in 2020 because of the maturity profile increasing in the coming years. They might actually be back to buying almost as much as they have this year. So that is still a supporting factor, which if I think about a country such as Croatia, you won't have the direct investment, of course, but you will have that as a still supportive factor in the market for quite a few years. Doesn't say you can't have spread widening. I mean, we did have spread widening, but it still sort of calms down or reduces the risk of any overshooting. And for the last 4 years, sectors that were not in the scope of the Eurosystem buying did benefit from it as well, simply because of everything being pushed down and investors trying to rebalance their portfolios to the slightly higher yielding sectors, which they still perceive to be high quality. And for example, one big area of the sort of own funds and pension fund investments by the Eurosystem has been non-eligible covered bonds, because they were kind of banned from buying the Eurosystem APP eligible assets. Didn't want to step on their colleagues' turf, so to speak. There isn't much in terms of non-eligible public sector assets, and covered is a pretty big and chunky market in countries such as Canada, Australia are big. You have the Nordics, and to some extent, to a lesser extent here out in Central Eastern Europe as well. But that's been benefiting those markets. And as I mentioned, we've seen one leg of repricing since March. We might see another one in January with issuance sort of restarting as you usually have as far as sort of normal seasonality is concerned. But I've also mentioned that we're sort of starting to approach normality, or as normal a market as you can expect, with redemption reinvestment still happening in the coming few years. Just one word on green. As you mentioned, it is still a niche product. There's been a few issuers out of Germany that have used it because they fund commercial real estate lending with covered bonds, and it's easier to identify a 50 million loan or a number of 50 million loans and assess their greenness, so to speak, than having a few thousand of retail mortgages. And there's not yet a clear sort of definition as to what the market or what regulators as well would consider to be green. There is work being done by the ECBC, EMF, so European Mortgage Federation, to sort of define a green or energy efficient mortgage. The moment you have that, and the Commission I think is quite happy to support that as much as they can, the moment you have that, the link from the asset side to the funding side is like this. I mean, that's really quick. So once you have that, your projections are probably going to be, even the optimistic ones are going to be really pessimistic, but if you don't have that, even your pessimistic one is probably going to be really optimistic.
Thank you very much, Florian. And just to say, EBRD is also an advisory council of ECBC work on green. But you said really interesting points on the QE decreasing and how it impacts development of the market and the change, the seasonality or lack of seasons in covered bond calendar repricing, and then also the change of behavior of the biggest buyer who will started buying a bit less. I wonder how all of that plus on the side the Covered Bond Directive, Thomas, you think would or may not or may have already impacted the covered bond market in Central Eastern Europe?
Yeah. Hello. Well, I'm Tomas Rodriguez. I'm a lead analyst in the Moody's for the last 10 years, and I'm the analyst of Slovak, Czech, and Turkish covered bonds, amongst others. But yes, as Jacek has said, I'm going to give an overview on the CE covered bond market. And sometimes it may seem that covered bonds are a new product here in the CE region, no? But far from being so. We rated our first covered bond back in 2004 in Hungary, so almost 15 years ago. And since then, we have rated covered bonds in Slovakia, in Czech Republic, in Poland, with ratings that range from BW1 now in Hungary to AA's, and also, as you have mentioned before, 1 AAA in Slovakia, no? And we are analyzing some other markets like Romanian or the Pan-Baltics. And covered bonds are a key funding tool for housing markets, and also in some of the countries of this region as well, like could be Hungary or Slovakia or Czech Republic, where covered bonds may mean 20% or more of the housing loans. No? And we have seen a great development on the last years. In fact, issuance in 2017 doubled that of 2016, no? And there are some issuers in these countries that are considering to finance their growing mortgage loan portfolios with covered bonds. And I think that the main factors, of course, apart from the benefits of issuing covered bonds in terms of costs and in terms of funding over longer maturities, of this great development are, first of all, the economic growth in most of the region. So you have seen disposable income growing, we have seen unemployment rate decreasing, we have seen, low interest rates. No? In the end, this make borrowers to repay their mortgage debt quite easily. And this is great positive for covered bonds. But as well, these factors make the volume of housing loans to increase a lot. And we have seen in some countries, for example, Czech Republic or Poland, that the volume of housing loans has doubled in the last 10 years. But in Slovakia or Romania, it has tripled, and I mean, it seems that banks need a way to finance these mortgage loan portfolios. And the second factor, I would say that, and it has been discussed and it will be discussed a lot here, is the harmonization of the covered bond frameworks. We think harmonization will keep the favorable regulatory treatment for covered bonds, which is a great positive for all European covered bonds and also here in this region, because we have seen some outdated legislations and also some other countries without any covered bond framework. And we think the harmonization will keep the depth and the liquidity of the covered bond markets, which is again a very positive, no? And we also see some risks, of course. We see the rapid increase of some housing markets in some countries. We see as well a rapid increase of the house prices as well. We think, of course, this is negative because people will borrow more money and contribute less equity when buying a house, which is, of course, negative for new loans that enters into the covered pools, no? In the future. But we have seen as well some mitigants here. We have seen most of the countries that have developed regulatory measures that restrict leverage and also that limit loan to values, no? As could be, during the last summer we have seen Hungary, Poland, Czech Republic, Slovakia that have done so, no? So that is quite positive because it mitigates these risks to some extent. So, in summary, yeah, what we have seen is a great development over the last years, and due to harmonization and economic growth, but we still see some risks, as could be the house price increase.
Thank you very much, Thomas, and you're right, especially on the house pricing increase. It's been a steady few years when in Central Eastern Europe they really do grow, but also the unemployment goes down, and that's a positive impact for the mortgage market development that in turn comes to also covered bond market development. I wanted to turn into Kuba because we've heard, or to Jakub, we heard Poland mentioned a few times. You're representing one of the biggest mortgage covered bonds issuer, and that is a part of the biggest Polish bank group, and you basically created that market. I wanted to hear a bit more about the experience in setting up and establishing the market, because a few years ago there was no covered bond market in Poland, now it's changing, and I wonder whether your Formula F1 cufflinks that you have demonstrate the speed of change and development of that market.
Working. I'm Jakub Niesłuchowski. So actually, I'm fresh to the market. So taking Richard and all of Florian experience. So still, I feel definitely like a freshman. However, as it was already indicated, we did a lot actually. So I'm responsible for the covered bond issuance. So the most, I would say, exciting thing in the mortgage bank. However, actually, my more experienced colleagues are telling that due to their stability, covered bonds are boring. But I tend to not agree to that. Actually, it took us a few years actually to be in the place where we are currently. So pretty quick, because although we had a law, what was indicated in the presentation by Andreea and Jacek, starting in 1998, however, the law was not perfect. So we got 2 mortgage banks or 3 mortgage banks. One was dissolved, but the market was dying. The impulse came from the new law, which was introduced January 2016. So I can say that we have completely new law. It was really game changer. And here, thanks to support of EBRD, we were able to do it, and also taking experience from other markets. Also colleagues from rating agencies, we also learned from them how we should structure the law. That was actually one building block of our success, so new law. Why it's so? It's actually increased the safety of our covered bonds, take into account OC level, liquidity buffers, but also what is very important, opens the market for foreign investors. One of the barriers was withholding tax, and it was eliminated for the foreign investors. And also, when we're creating the law, what was important, not only the activities of the mortgage banks as the entity which are actually able to or allowed to issue covered bonds, but we also took care about investors. So what was also introduced, a limit, for example, for the pension funds, a separate limit for pension funds to invest in covered bonds. So it's very important, not only, I would say, create a or covered bond market for the issuers, but also look on the investors, both on the local market. It was also told by Andreea that we base on the local market and also on the foreign market. So we took care about 2 of them. And so we started with the new law. Then it was very important for us to actually, as a market leader, because PKO BP Group has currently around 30% of the mortgage market in Poland, which is 100 billion zlotys. Actually, we want to be responsible and originate lend responsibly, which we learn also from more experienced markets, that it means that we should have covered bonds. That's why our group decided to set a mortgage bank to issue covered bonds. So it was strategy decision. But what was important, and again, it was already mentioned, so I don't want to repeat too much, economics. So simply, the financing with covered bonds is cheaper than senior unsecured. And our group, our banking group, actually replaced existing senior funding with cheaper covered bond funding, both from the European market, as we are issuing in euro and swapping to Polish zloty, and the euro is taken by the mother company. And they are simply replacing their existing financing in currency to financing with covered bonds. And also financing from the local market, which we also are ready to obtain at much better price than the senior unsecured. So that is actually also strategy, but also here economics. And here Richard mentioned on the presentation that roughly 30% of the mortgages are financed with covered bonds. That's one of the goals which we have on the Polish market, we also as a group. Yes, so now as a market, we are on the 5% level. We as a group are more at the 15% level. So still a lot of to go, but we are, I would say, determined to do it because we see importance of covered bonds, responsibility, but also economics here. And yes, so this Formula One will go further, definitely. So we look on the one hand, further plans to issue. So what is important for the investors? To be a regular issuer of covered bonds. So it's our commitment, which means for us that we will be present each year on the market with at least €1 benchmark transaction, which means a minimum 500 million, but also we do care about our local investors. So here concerning, I would say, local investors, what was needed from us, a lot of educations. So I got a lot of meetings with the investors to present them covered bonds. Actually, what is it? And why it's actually worth to buy it. Yes, for the more safe part of the portfolio. Yes, invest and forget about it, and take care about more risky investments. So that was important, and what was mentioned, finishing words concerning green, because it will also rise during the presentation. So we do see.
I don't think Formula One and green go hand by hand.
Yeah. So that's good. That gives us a lot of comfort, actually, because here we do see importance also to be on the green covered bond market. It's expanding. Both here we'll also look on the European, but also on the local market. It got some challenges. For example, identification of green assets, and also introducing offer for green financing for the customers. But why we are doing it? Because we do not see for now, I would say, visible difference in cost of financing. But what we do see is that investors creating or have green pockets, and we want to get to these pockets because it's actually leads to extending of investors' base. So we are now on the preparatory stage. We are creating the framework, and our plan is to be on the green covered bond market next year.
Thank you very much, Jakub, for that and for the statement. We will take it on record for the next year green covered bond coming out of Poland. You touch upon some really important points, but one which is very relevant, I think, also for Croatia. We look into international investors, but we also look into domestic investors. And if you look into domestic capital market here, pension funds play a big role in investing into capital markets. And that's something that on the investor limit, we also made sure that in the draft law is being addressed, so it allows for the investment in covered bond as an instrument. And that brings me to Richard to talk about completely different success stories on the first ever AAA bond issued in EBRD countries of operation. So I wonder, how was it to prepare to align your operations and your business with the new law? How difficult that was? And how are your discussions with the investors? And then we'll come back to Andreea on the international investor perspective.
Okay, hello everybody. My name is Richard Košecký from Slovenská sporiteľňa, Erste Group. I wouldn't say that it's completely different story because I see quite a lot of similarities to the Polish story. So it's step-by-step process. So it's always starts with the legislation. In our case, it started in 2016. I would say the first discussions, and the law became live in beginning of 2018. So it took 2 years to set up the legal framework. With regard to the rating, we started, I would say, like 1 year ago, preparing our covered bond program. What was important for us, we put quite a lot of effort into that. So we would like to prepare the portfolio, the loan, the assets which are very clean, very conservative portfolio, so only residential mortgages, no FX loans, very, very, very clean portfolio with a nice seasoning, with a nice LTV and so on and so forth. So we were expecting quite a nice result out of it, and actually we got the best result, which was the AAA rating. Of course, big success, but I would say a lot of work behind. I would mention also maybe the work on the bank itself. You need to have really the infrastructure. So you need to have the policies, the workflows, and at the end the data in place. When I check what is really required, I was quite surprised. For each loan or each transaction, we need almost 200 fields. So 200 different data, like about the customers, about the credit, about the income, and so on and so forth. So to fulfilling the requirements of the national bank or for the regulator, rating agency, we need to have around 200 fields for each transaction. What was great was that we had those data, but as you know, there are always at different places, at different data marts. So we had to do quite a lot of work to put the data into one centralized place. And currently we have it. We can produce quite regularly the data on very frequent basis, at least on the monthly basis. And for the future, we would like to do it on the daily basis. What changed from the business perspective was, this was already mentioned here, that we always had to fulfill these minimum financing ratios, which was the case before. So any time when the loan portfolio increased by something, we had to immediately issue the transaction, the covered bond, which was obviously the very low, very small ticket. And the small ticket means that you don't have a diversified investors, that the liquidity, secondary market liquidity is very poor, and so on and so forth. So in July this year, we received the license from the National Bank, fulfilling all the criteria. We have an independent cover pool monitor or administrator. We received the rating, and we did our first transaction. And the first transaction was in the amount of 250 million, which was for us like a dream. Before, we always did like 30, 40 million transactions, which was very costly, no liquidity, and so on and so forth. So we did a transaction. We attract mostly local investors from Slovakia and Austria. And we did it quite attractive level. So we did a 7-year bond with plus 12 basis points. For us, of course, it's cost efficient. And comparing to the maybe German market, you see there is always some pickup. But what is the reason? I would say the main reason is that it's Slovakia. There is certain spread of Slovak govies versus the German govies. And plus the liquidity. I still have to say the secondary market liquidity is not ideal. So there is a certain pickup or spread add-on due to the liquidity of this bond. So it happened. We have a AAA rating, but there is still quite a lot of work to do. As Jakub said, we want to go. We would like to attract foreign investors, so go more to the west, to the Germany, maybe to Baltics, Nordics, and so on. And hopefully we will achieve also from the not just perfect credit and safe investment, but also something which is quite liquid and so on.
Thank you, Richard. I have a follow-up question from your experience with the 250 million issuance. Who are the investors geographically that were really interested? Was it mostly domestic, or you had some of the internationals coming to your door as well? Or you coming to their doors?
For me, it was local market. For me, local market means Slovakia, Austria, basically these two countries. From the type of investors, mostly banks and the pension funds. Mm-hmm. a little bit insurance companies, and then of course the supranational institutions like central bank.
Thank you for that. You said something which was really nice, that the 250 million euro bond issuance was as a dream for you. Sandra, when you look into covered bond investment and decide what you would like to buy as a bank or not, what is a dream and what is not a dream come true looking into the investment side?
Well, I mean, we are a development bank, but when we look at the investments in covered bonds, we have a commercial perspective as well. So we are looking at different things. So first of all, I mean, of course, the legislation has to be there, and it has to meet the criteria. So it's discussed. If the legislation is not there, as we've seen, we amend or we create the legislation. But once we have a law, we like to work with the issuance, targeting the first time the markets, and we support. We like to be there for them at first when they go for the first time to the market. What we've seen is mostly initially on the local market. This was set there, which we believe is very important to develop the local capital market. It's one of the strategy for EBRD, so supporting the first-time issuers on the local market is part of their objectives. We act as a cornerstone investor, as we like to say, in the sense that we can take up to 20% of an issuances, of course, subject to the final terms when they're available. We have certain requirements in terms of the investment criteria. We require our investments the issuance has to be rated. This is one of the criteria. So we can't invest in the unrated covered bonds. We believe that this is very important for developing of a covered bond market to have rating. We've seen in some of our markets, especially on the small type of issues, that the local investors, they don't require a rating. For us, it's very important to have a rated program. We don't have a certain minimum rating. As I mentioned before, Greece is one of probably the best example where we invested in a single B covered bond. So we don't have we don't require a minimum investment grade as long as it's rated by one of the three rating agencies. In terms of size of the issuance, we are quite flexible, but it has to be obviously commensurate with the size of the local market. We don't require to be sub-benchmark 250 million. I mean, in Poland, the first one we invested, I remember, was 500 million zloty, so about 120 million euro equivalent. So it depends on the size of the respecting market. ECB eligibility, because most of our countries are not in Eurozone, the covered bonds we invested were not part of the covered bond purchase program, except for Greece, that it was initially, and then it was not. So we don't require to be part of it. Of course, if it's an ECB eligible bond, it helps. We require, transparency and disclosure is very important for us. There is some initiatives, as we know, from the ECBC in terms of the transparency template. We like to see proper disclosure to the investors. Unfortunately, this is an area that in some of our markets is not, because it's not, the regulators, they don't require this, and we work with the issuers towards this, because we really like to see proper disclosure to investors, so everybody has access to the information. And the directive, it helps from this point of view. In terms of liquidity, we are whereas any other covered bond investor, although we have maybe a longer term horizon than others, but we like to see some liquidity, some market making activity for the covered bonds we invest. Although we are aware that in some of our markets it's quite difficult. I mean, Richard mentioned Slovakia, actually, which was one of the examples where, although we've seen some sub-benchmark issuances recently, if you look on the the liquidity on the covered bonds traded locally, it's not that high.
Thank you. And the currency side?
Well, we have access to local currency, so we have appetite to invest in local currency as well. So we invested in zloty. We invested in the Hungarian forint. So we are basically, we are flexible from this point of view. And actually we like more local currency. I mean, this is what you wanted to hear, Jacek.
Sir, I'm from local currency, local capital market team.
So we prefer to invest in local currency, but we are also aware that to attract the international investors, it has to be in euro benchmark issuances.
Thank you very much, Andrea. Before I give the floor to all of you for concluding remarks, I wanted to check whether any one of you in the audience and also looking into Croatian market in the back of the room has any questions or points that would like to hear a bit more, or we can elaborate on that may be relevant to hopefully your future business. Don't worry, I'm not putting you on the spot. There is also a coffee break that we can network and go in the next 5 minutes. But before that, I wanted to look into the panelists and see whether you have any concluding remarks, comments, agreements or disagreements to whatever everyone else mentioned during the discussion. Florian, you look like you want to say something.
Yeah, because she's blocking the microphone. No, I just wanted to, because I was sort of brought on this panel to get a bit of an international perspective as well, because Andrea's talked about how she looks at investment, which is perfectly fair and well for the purposes that you guys have, but it's not necessarily identical to how international investors would look at covered bonds. I mean, the focus on framework, on policy, on supporting, in your case, is much bigger than it would be the case for, let's say, a Eurozone bank or a German asset manager. There it really starts with the sovereign. If they're fine with that, then they go any deeper. If they're not fine with that, most frequently they would just kind of stop the process there and then. Then next comes the issuer, because we're talking about bonds that are issued by financial institutions. I mean, the framework and collateral is all nice and well, but you don't really ever want to rely on that. If you're an asset manager or in general an investor in covered bond space, and then comes the framework, and then comes the collateral. So it really starts with the sovereign, and then sort of trickles down into the pool at the end of the day. Size-wise, you have those thresholds where it starts with 250 million when sort of bank treasuries start to pay a bit more attention, because these bonds are then LCR eligible. For an asset manager, it's essentially 500 plus, unless you really pay up spread-wise. And for the insurance guys, I mean, they look at private placements, and there the bigger issue is, can issuers actually provide them with long enough duration? Because in many cases, the assets just wouldn't be long enough to issue 20, 25-year private placements. So it's a slightly different angle than what you mentioned. Having a domestic currency investor base always helps. To be completely delinked from your local sort of market is always seen as a bit of a not so ideal, because ultimately the ones supporting the most in times of stress are going to be the ones that know these institutions best, and that's ultimately the local currency or the domestic guys. But it's not an absolute binary requirement. If there's no local market, then people don't buy. I mean, we have quite a few examples where issuers use covered bonds to expand into different currencies, and the local currency stuff is issued in senior or non-preferred or sub. So it's a bit of a different angle.
Thank you for that and getting us a market background. Kuba?
Just to comment that from my experience, I totally agree that we actually sell Poland starting from the macro view, banking sector, and then we come up to the actually bank itself and the cover pool. But another, I would say, point is that the foreign investors, let's take German investors, they are investors who are investing in covered bonds from many years. And they know the questions and what they want to know, and if you convince them, then that's my experience, at least after 4 benchmark issues, they are constantly buying your covered bonds. So from this point of view, sometimes discussion is, I would say, more easy than with local investors, because this is what I actually mentioned, that it needs a lot of education. In Poland, we do not have, for example, analysts which actually take care of covered bonds. So we have to educate people. What is investors, and of course, why we are paying not so much. That's always. So I got comments. Okay, you have Ferrari here, but no, not everybody should have Ferrari. So that's comments which I had, for example, with the discussion. So sometimes of course, we do not have to cover macroeconomy, etc., banking sector, discussing with Polish investors. And here my comment is that that's why very good that Andrea is more keen to invest in local currency, because our example shows that we need more support on the local market than on, for example, European market.
Thank you very much. If there are no more comments, firstly, your Ferrari brought my thinking to my little Fiat 500, and on that positive note, I wanted to say big thanks and a round of applause from all of you to our distinguished panelists, Florian Eichert, Tomas Rodriguez-Vigil, Andreea Moraru, Jakub Niesłuchowski, and Richard Kosecki.